Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is Tech Talk Tuesday. I'm David Blake, and this is your first time attending. I want to thank you for joining us. What we're going to do is we're going to go about 20 to 25 minutes today, look at a couple of charts, some sectors, some industries that we think may be leading the market higher or lower. And after that, what you can do is you can in a little speaker box, you can type in a question, ask us anything about sectors or individual stocks or market direction, anything you have on your mind. We'll try to go over it. Okay, we're going to look at where the major markets did last week over the holiday weekend, and it certainly wasn't much. Basically, we were flat. It was a consolidation period after the big run-up we had off the September lows. The week before that, of course, we were up about 3%. It was the first or second biggest gains of the year. So we were due for some consolidation, but the underlying technical indicators were neutral last week. They improved slightly. However, even though it was a flat week, we did see internal breadth improve with both the NYSE and NASDAQ AD lines. Both were higher. We also, for the first time since, I believe, in early October, we actually had the new 52-week highs outperforming the 52-week lows, which is a plus going forward, especially while you're consolidating. As far as the sectors went, there wasn't not much going with either of them either. We had the consumer staples sector, the energy sector, and healthcare sector led the way. None of them by any more than about 0.5%. And that was offset by weakness in utilities, technology sector, and also the industrial sector. We did have the consumer discretionary sector made a new 52-week high earlier. We'll take a look at that chart later on. And like I said, also the technology sector continues to lead the broader market. Today, we're having kind of a broad-based rally. The market was up about 150 points out of the gate. It's since we actually got some weaker economic data early in the day. We had ISM manufacturing data for November, came in at 48.6. That was showing contraction in manufacturing. That cut the gains just about in half. We were up about 160, but came all the way down to we were up about 50 or 40 points. And that number actually was the lowest we've had since November of 2012. Was the last time we were under 50. In manufacturing, and that number today, the 48.6, was the lowest since November of or June of 2009. So the market had to check that out for a little bit, but now we're back up. We're up about 107 points and trying to move a little bit higher. Okay, the first one we're going to look at today is the Dow Jones. Again, we saw yesterday. We're kind of stalling out up here. The real resistance is up here about 18,000. We're up here right around 17,825 right now. Can't quite make it up to the highs of a few weeks ago. Once again, some of the indicators are showing negative divergence, especially the 14-day RSI, although the rate of change, which is another momentum indicator, a shorter term, is beginning to play some catch-up here, and we want to see that. We'd like to see all these, as the market makes new highs or attempts to make new highs, you want to see the underlying technical indicators confirming the move and showing the strength. So right now we're stalling on the Dow. The S&P 500 kind of has the exact same thing going on. Resistance up here around 2,100. We got to 2,091, I think, this morning. That's right about where we are today. Again, the S&P 500 is also beginning to stall out here. The negative divergence in the indicators are still showing up. But again, the shorter-term rate of change momentum indicator is starting to pick up some steam, and that's good. We want to see this thing if we can get through around 2,100, or maybe even if we can get through 2,110 or so, we have a shot of the S&P 500 perhaps making it up into some new highs, which would be good for us going forward. The NASDAQ seems to be outperforming, but again, the same story. It also is stalling up here at the highs from a few weeks ago. Again, some negative divergence in the 14-day, but the 10-day rate of change, again, is starting to confirm the move. And again, the underlying indicators that we had with the internal breadth numbers bodes well that we may we may get a chance to go here. What you want to watch for on the NASDAQ is a break up here around of above around 51.45. I think right now we're at 51.35, so it's bumping heads up against that old high number. We're going to see if we can probably break through that maybe. Okay, here's the Russell 2000. It's had a great couple of weeks. You want to see outperformance by the small caps if we're going to crack the new highs. However, same old story here, a little bit of negative divergence in the 14-day RSI. And this one is going to have some significant resistance up here at the 200-day moving average. As you can see right up here, that's right around 2014. Today we're at 1196, so we can't quite get up about that 1200, 1202, 1205 area. A break above that 2014 area in the 200 would probably signal that we could get a pretty good move up here for the end of the year. But as of right now, you still have to say it's stalled. But keep an eye on that one. If you've joined us over the last couple of months, we've talked about the Dow Jones transports, where I think that would probably be the index that rings the bell for the end of the year rally. And once again, same old story. We get up here around where the old highs are over the last couple of months, and we stall out, and the thing rolls over. Now we are finding support down here at the 50-day moving average, which is good. But again, you want to see the Dow Jones transports probably trade above this 8,400 area. And look at the momentum indicators down here on the 10-day and the 14-day, not much. A little bit positive, but just barely. So today we are at 51.33 or 81.33 on that 81.21, and that's just right around this area again. You're still bumping up against resistance, and we need a little bit more from that. Now, one thing that has been improving is the Philadelphia Semiconductor Index. The last couple of days, we've been up about 3 or 4 or 5 days in a row. We're starting to see some positive momentum over here on the 10-day rate of change. RSI 14-day is starting to catch up. You were actually up today about 1% again. So you are getting some. You are taking out this old high from about 2 or 3 weeks ago, from mid-October. That's a positive. Now, one of the negatives on that, you also have a nice rising trend line that for support, that if it comes down here and tests the 200-day moving average, I would imagine this would probably stop any selling off. The stocks yesterday, like NXP, Semiconductors, Micron Technologies, Intel looks good in here. You can go into the industry group on Market Edge and look for some semiconductor stocks, but they are looking pretty good here, especially the larger cap names seem to be outperforming the smaller caps in this index. But I certainly would look at some of these stocks to buy. If we can get a break up here of around 57.5 or so, that would probably indicate that you could get a run back up here towards the old highs. Okay, well, before we talk about some of the financial stocks that was in the email, I want to just run down the sectors real briefly. Again, here's the materials sector. We've had a nice run up off the bottom. Same thing as the regular indexes. We're running kind of stalling out here right around $46. We're still well below the 200-day moving average. The debate with the materials, of course, is are they stalling out here because of the strong dollar, which does affect commodities, or is it because of slow global demand? If we can see this thing get up here around 47 and break through that, that would be probably a good indication that even the global markets and emerging markets, it would be time to go into some of those. But again, we're stalling at this level right here. It's underperforming today, so we're not getting any indication one way or the other for that. Okay, here's the energy sector. We talk about this every week and what's happening with oil. Oil today was off about 1.5% earlier today. Again, we just cannot get out of its own way over here. We are finding support at the 50-day, which is a positive. But look at the negative divergence here on the 14-day RSI, and you're really not, even on the 10-day, you're not getting much oomph on that. I do think you want to watch that $40 level on oil. If we break below that, you're more than likely going to get a pullback down to around the $38 range. At that point, I think you probably go in and you buy your Exxons and Chevrons and start to build positions in that. But today we're at 41.56, and $45 was was the line in the sand earlier. Now I think we want to watch the $40 level. We almost broke that as October ended, and we had a big pop here. In fact, also on, I believe on Thursday, OPEC meets, and we could get some more news on whether the Saudis are going to cut back on their production or not. If they don't, you could probably see oil roll over, and you'd probably also see the oil stocks roll over. So keep an eye on the crude oil for the January. And if you want to also follow that, you don't have time to follow it on internet. Our daily commentary talks about what oil is doing every day, so you can get to follow the prices on that. Okay, here's the financial sector, which we'll look at deeper here in a minute or two. Same story. We've got above the 200-day moving average. We're up here in the 24 area, and we just cannot plow out the new highs. It seems to have stalled over here. The same negative divergence on the 14-day and the 10-day momentum indicators. We need a pop up here above about $25, $50, $26 on the financials. In fact, one other thing on this, a lot of the people are talking heads on TV. You hear them talking about that you want to own the financials going into a rising rate environment. That's true to a degree, and part of that is what's more important than just the fact that they're raising rates is the fact that you want to see you don't want to see the yield curve beginning to tighten, which it actually is. So follow the two-year and the 10-year on that. As you see that flatten out, that's going to take some of the luster off some of the financial stocks. But we will look at which ones you may want to go into here at the end of the talk. Industrials. I'm lukewarm on industrials. We did plow through the 200-day moving average. We made a recovery high here last week, but you want to be selective on this. This over here, this run up here, a lot of that was on Lockheed Martin, Raytheon, after the bombings in Paris. So be careful over here. Also, the multinationals will have some U.S. dollar exposure. That's going to put a little bit of a limit on some of those. So be selective in your industrials. Technology, you're up here challenging your 52-week high. A lot of that is due to the semiconductors in here. And again, this is also, you're seeing big moves still in your Google, your Facebook, what Jim Cramer calls your FANG stocks, your Netflix, all. So the big names are really pulling this thing up. But the fact that you're seeing the Russell 2000 and the small cap stocks starting to gain some momentum, and that the semiconductors are also starting to break out to a new high, that's very positive. You've got what you call a golden cross with the moving averages. That's the 50-day coming up through the 200-day moving average. That's a bullish sign that longer-term investors and fund managers will watch, because they want to own that one, to be in that sector when that happens. Okay, the next one we're going to look at is consumer staples. You had a run up to new highs here a couple weeks ago after this sell-off. Same story. We've kind of had a little bit of a stall in here, but you don't have as much negative divergence as you do on some of the other stocks and sectors. So I would be looking to buy some of the consumer staples. Stocks in here that look good. Kimberly-Clark, Clorox looks good. Here's a picture of Clorox over here. You can see it made a new high here a couple weeks ago. Stair-stepping higher. You got higher highs and higher lows. That's what you want to look for. A little bit of negative divergence in the RSI, but the 10-day rate of change is confirming that the move is probably higher. If it takes out this 126 area, that's even more bullish for that and for the total sector. Okay, we have healthcare. It's another stalled sector. You're right below the 200-day moving average. Can't quite get to the resistance there. Maybe it was lower than it was about 2 or 3 weeks ago. But I still think this is one you probably want to buy, own on pullbacks. And the reason being, I'm going to show you a longer-term chart of healthcare. You can see that you can draw in all sorts of trend lines, rising trend lines on this. You just had such a big move over 2014 and part of 2015 that any kind of a pullback down here and say in the 66 area for the XLV or some of these big drug stocks, I would be buyers, even on some of the biotechs, because it's not a broken sector. Now, if you looked at the long-term trend line on materials and energy, you would see with the longer-term trend line, they actually broke that, and they would be down in here. and until they can actually get back above that trend line, you kind of want to be cautious on the materials and energy sectors. But this one here, on pullbacks, I would be buyer. The longer-term trend is the stuff that they're doing in healthcare. You want to be a part of it. Okay, here's the consumer discretionary sector. Actually, some people might say this is a double top. I think this is you're getting ready to break out with the consumer discretionary and make a new high. I would be a buyer of some of these stocks. I wouldn't chase all of them, but you do have some great-looking charts on here. Here's Home Depot. As you can see over here on their earnings, it's a rocket shot up there. It had a little bit of a pullback. I wouldn't chase these right in here, but I would have them as stocks that I want to own on pullbacks. Home Depot, it just keeps moving up. Here's another one here called Alta Salons. This stock has a lot of room to grow. You know, one of the things you may look at, even in a slow economy, the girls are going to go out and get their hair cut and buy some makeup. That's good for us guys. We love them for it. But you have a chance here where you can probably make a new high. My niece called me actually about a year ago from California, and Alta was just moving into, I think, the Los Angeles area. So they've got a lot of growth opportunities out west. She couldn't believe the store. Her and all her friends go there. And I know that here in Atlanta, they're always packed with people going. So that would be one that I would own. They've got a nice story. Another one in the retail specialty store, Costco. You had a nice earnings beat over here. Ran up to new highs. You're churning up here, consolidating some of this gains. The momentum indicators are positive. I think I would want to own Costco. But if you go to the industry group on Market Edge, you can find a whole list of stocks. Here's Dollar Trees. A slow economy, everybody goes out and buys something for $1. You came up here, ran right into the 200-day moving average. You're trying to get through that right now. But I'm seeing like kind of positive divergence in some of these indicators down here, especially the rate of change momentum is flying up to a new high. This I would probably look for a little bit of a pullback, and I would be an owner of it. But if you go to the Market Edge Industry Group and Advanced Tools, take a look at the retail specialties industry. There's a whole list of stocks in there that are doing well. You can look at AutoZone, Pep Boys, even Lowe's. They all have great-looking charts that are running over here. Okay, before we open up for questions, I want to talk about some of the financial stocks and what areas would probably do better than others. Specifically, I think you ought to look at the online brokers, and we're going to take a look at a couple of these. This is a chart in the industry group. It's called Internet Financial Stocks, and you had a nice pullback with the whole market over here. It didn't quite correct as much as some of the other areas, but since this September bottom, you've had a nice run up. The fact that the Fed's is going to raise rates in December is not slowing it down. And year to date, this industry group is up about 24.5%. So a lot of people are buying it in here in anticipation of that. Now the stocks that make up this sector or industry right here would be Charles Schwab, E-Trade, TD Ameritrade. Another newer one on the street would be Interactive Brokers Group. The street, not so much. It's not really in the same category as these. But the big three, the Schwab, E-Trade, and Ameritrade, would be stocks that I think you want to own. There was a article in USA this year talking about the big three online brokers. It calculated that E-Trade will pull in about $1.2 billion in interest and dividend income over the past 12 months, and that actually comes out to about 3 times the revenue from trading. A stock like Charles Schwab did even better. They pulled in about $2.4 billion from interest and dividends, and that versus about $887 million from commissions. So these stocks benefit exponentially from any kind of rise in interest rates. So another thing to consider is that where rates are right now, Schwab and I don't think E-Trade either. Neither one of these are currently buying any are charging any fees for you to invest in their money market accounts. Once we get up to maybe where you're getting 0.5% or maybe even 1%, I think what you'll see is they may start to charge some fees, which would be even more money that would pull into their revenues. So a lot of investors are already familiar with these companies. Here's Charles Schwab. You had the big sell-off. You've already retraced about 68.2% of this sell-off, which is a Fibonacci retracement level. You're running into some resistance up here, but you know, a little bit of negative divergence over here in the 14-day RSI. But I still think this is one that you'll see move up, and I would probably be a buyer. You're still below the mid-year year highs. This next chart is TD Ameritrade. Again, a strong bounce off of the sell-off. You're up here testing the old highs from the summer. Going to be in that trading range. Once they begin to raise or hike rates, you'll probably see another bounce out of TD Ameritrade. I think I would be a buyer of that stock. Lastly, here you have E-Trade Financial. I believe they actually do more in the loan business than probably the other two. But this one here is also challenging the old highs up here around $31. There's some good positive momentum. You've retraced 68.2% of the pullback. I would be a buyer of the of E-Trade also. So one last thing to consider. Other stocks that could benefit from this would be like Paychex would be one. ADP, which does a lot of financial work, financial diversified services. That would be another one that you might consider. And also, if you go once again to the Market Edge Industry Group analysis, you can pull up under the industries financial services diversified. You're going to see stocks over here: American Capital, BlackRock, Main Street Capital, T. Rowe Price, Franklin Resources. All of these, as you'll see over here, the opinion is long, which means they're already in an upward trend. We also will tell you which ones we think will probably outperform the others going forward. So you can find a whole list there of stocks. Take a look at the charts, read the second opinion on it, see what how we like them, whether they're starting to break out to a new high or not. And again, here's how this sector is starting to perform. Year to date, you're down about 10%, so it's time to play some catch-up ball. And this group of stocks, I would be a buyer of. Okay, so I'm going to open it up now to some questions. If you have some individual stocks you want to ask me about or any thing like that, let me pop this over here so we can record, share the screen. Let me pop this closed. Start. Okay, here's the, can you see that? I'll make sure we can see this, see these charts here. Okay. All right. Let me open it up over here. If there's any questions, let's see here. If you have in the chat room, you can put something in there. Oh, here we've got one here. Okay. What do you think of online retailers in the wake of Black Friday and Cyber Monday? I like the online retailers. We had, if you take a look right now, let's see, I'm trying to think who it was. ComScore, which is a research firm, they actually, even though the Black Friday and the brick and mortar stores was a disappointment, I think they're calling for Cyber Monday, if that's what it's called, to be up about 10%. Going to do about $3 billion in sales. That's an expansion. There's nothing not to like about these charts. Here's Amazon. You have higher highs, higher lows. In fact, you're making a new 52-week high over here. I don't like this negative divergence right here, and also the MACD short term is a little bit negative. But I hate chasing something that's moved this much. You're up 20% here since the October low. But on any type of pullback in here, if the market pulls back, and I don't expect to see the market do a heck of a lot over the next week or so, any type of a pullback, I for a long-term hold, Amazon looks good. I think another one is eBay. Here's eBay. It certainly hasn't had the price move as Amazon has, but again, you are striking out here to new highs. You got the MACD short term over here looking to probably give another buy signal. So I like these stocks. As far as the brick and mortars, quite frankly, you look at Walmart. This was flipped over. This would be a great looking chart. that's a little bit, kind of weak. Here's target. Again, you're making lower lows and lower highs. So I don't think you're going to see much buying in these stocks in December. That's for sure, especially after that Black Friday. They'll have to see what kind of sales they get from online sales and that type of thing. So I would be hesitant for this. But the eBays and the Amazon, I think longer term, they both look good. What do you think of CBOE? Good looking chart. Okay, I think the exchanges are probably going to do pretty well. They were able to stomach this year's trading range, but the CBOE looks strong in here. The chart looks great. Higher highs, higher lows. The RSI is also making higher highs and higher lows. Positive divergence. Short term looks good. See, where's support on this thing? You have a pullback. Support's way up here at around 71. I don't see anything wrong with that. Again, these exchanges will probably do well in a rising environment also. That's a good-looking chart on that. Okay. One of the technical analysts for Barron's wrote an article yesterday advising caution on the overall market and comparative situation in 2007. His main points were decline on balanced volume, weak MACD, and weak overall breadth. These are similar issues as 2007. He basically predicts issues over the next couple of months. Any thoughts? Well, if this is your first time in here, we spend a lot of time talking about internal market breadth, and I got to tell you, that's one of the things I've been cautioning people about all along here. And I'm going to show you a chart over here that you can find on Market Edge. And this is, as we're making new highs, okay, look, this is the advanced decline line for NASDAQ. Okay, so it's from this area here, it's gone up about 20% or 18%. And look at the advanced decline line. What that tells you that big move up in the NASDAQ has been on fewer and fewer stocks. It's a thin rally. Now, the advanced decline line on the New York NYSE has improved, but also while that rally was going on, you look at the new highs and new lows. While this thing was rallying, 17, 18%, we keep figures over here. I look at the number of stocks that are within about a 2% of the 52-week highs, and then I look at the number of the percentage of stocks that are within about 2% of the lows. Okay, while this thing's flying up here trying to advance 18%, you had about 10% of the stocks within 2% of a new high, and you had something like 23 or 24% of the stocks within 2% of the new 52-week low. That's not what you like. And also during that time, you were still making more new lows and new highs, which also is a weak projection. So I don't expect a heck of a lot to the upside unless the economies here and in Europe really start to pick up. We follow some cycles. We just went to a bearish cycle last Friday. It's been out of favor on our CTI for several years now because with a 0% interest environment, you really don't have any business cycles, and that relied a lot on the 4-year business cycle. So we still track it, but we went to a sell last week, and I think that you want to be careful the next 2 or 3 weeks. This thing, when you have a thin rally, you're always susceptible to pullbacks. What do you think of Energy Service Group, particularly WG? You got a nice rounding bottom in here for sure. That's Wilgro's Group. I'm not familiar with this stock on its own, but I do like the chart. You are getting some nice. Let me check one thing over here. Okay, this is real nice. This is something you can look at on charts. It's called the up-down ratio. It measures accumulation and distribution. Okay, well this thing's coming down here and starting to trying to struggle to make move up a little bit. The accumulation here has gone. The up-down slope has gone from 0.63 to about 2.88. That means there's a lot of buying going into this stock, and of course it's a low-price stock. It's only gone from 2 to 3. But there's a good chance now that you're up here near where it gapped down below. So a lot of times a stock will fill the gap. If this thing can come up here and get up here close to $4, you can see a slingshot move in that thing up to this $6 area. My only problem is I'm not wowed about the energy sector in general, especially if oil breaks below this $40 range. I would tend to have a little bit of an issue with that, which could slow this stock down. But for a low-price stock, you're not the only one that likes it, obviously, because you're seeing a lot of accumulation in that. So for what it's worth, like I say, people are buying it, and it also has staying above the 200-day. Anything else? Went a little bit longer than we normally do. Next week, we won't have a tech talk. I will be out traveling, but after that, we will resume again. Some of the things we're going to be looking at going forward are candlestick charts. We're also going to look at just how to look at some of the different moving averages that you may want to put on your charts to find buys, and also look at some of the different indicators, like different ways to use the RSI, the 14-day RSI, for entry points and exit points. So with that, we're going to go ahead and stop it. I appreciate you joining us today. There will be a link up on the site in about an hour or two if you joined us late, where you can look at some of the other ideas. Have a good week.